Hello everybody. At this time we are talking about depreciation. Depreciation is a crucial accounting practice that spreads the cost of expensive assets like equipment across their useful life. This helps businesses avoid the appearance of financial loss from large upfront expenses and match the cost of assets with the revenue they generate over time. Discover the importance of depreciation, how it reflects on a company's financial health, and learn about common methods like straight line and accelerated depreciation. And then how to calculate depreciation. Several methods can be used to calculate depreciation. Business owners are usually familiar with depreciation methods used for tax purposes. These require businesses to spread out the reporting of costs of longer-term assets over the useful life of the assets. But depreciation for tax purposes doesn't necessarily represent a company's actual cost for use of its fixed assets. It is common and acceptable for businesses to use a parallel depreciation method for financial reporting purposes that more accurately reflects the asset decrease in value. The most common depreciation methods are straight line and declining balance. And then we move to the main functions of depreciations. Depreciation serves two broad purposes. It presents a clear and accurate picture of your business financial position in line with standard accounting practices, and it provides tax benefits. Fixed asset depreciation ensures expenses associated with using an asset are reported in the same year as the revenue the asset helped generate. This is a key accounting principle. Depreciation also ensures your business is reporting the correct book value of an asset. A piece of equipment purchased for 10,000 US dollar 5 years ago will be worthless today, and your financial statements need to reflect that. Additionally, depreciation is an annual income tax deduction, and recording a depreciation expense reduces your taxable income, thereby reducing the amount of tax you owe. For example, a 10,000 US dollar screen press machine may lose 20% of its value each year. As a result, you could deduct 2,000 US dollar in tax depreciation expenses each year from your tax return, reducing your overall tax bill. And then we move to main purposes of depreciation in business. The first purpose, the cost of doing business. In order to understand how profitable a business is, there needs to be a clear understanding of all of the costs involved. Depreciation is one of these costs. Assets such as machinery and vehicles used in the business will wear down and will one day need to be replaced. Second, balance sheet depreciation. The value of some businesses is inextricably inextricably linked to the assets they hold. For example, the valuation of a shipping company will be based on the number of ships it operates. The valuation of this company will be greater if the ships are brand new and high tech. An identical company operating 20-year-old ships will receive a lesser valuation. Assets are listed on the company balance sheet in the fixed asset register. These registers should be updated every time depreciation is calculated. And then third, tax. Depreciating assets lowers the profits of a company. By lowering the profits of a company, you can lower the tax exposure during any given accounting period. By not allocating depreciation correctly, there may be a situation where a company is paying more tax than it would otherwise have to. There are strict rules relating to the depreciation of assets, but over the useful life, the entire asset value can be claimed of the tax. And then, what are the main types of depreciation methods? The first method, straight line depreciation method. Straight line depreciation is a very common and the simplest method of calculating depreciation expense. In straight line depreciation, the expense amount is the same every year over the useful life of the asset. And then second, units of production depreciation method. The units of production depreciation method dependent assets based on the total number of hours used on the total number of units to be produced by using the asset over its useful life. And then third, double declining balance depreciation method. Compared to the other depreciation methods, double declining balance depreciation results in a larger amount expense in the earlier years as opposed to the later years of an asset's useful life. The method reflects the fact that assets are typically more productive in their early years than in their later years. Also, the practical fact that any asset loses more of its value in the first few years, in the first few years of its use, with the double declining balance method, the depreciation factor is twice that of the straight line expense method. And then fourth, sum of the years digits depreciation method. The sum of the years digits method is one of the accelerated depreciation methods. A higher expense is incurred in the early years and a lower expense in the later years of the asset's useful life. In the sum of the years digits depreciation method, the remaining life of an asset is divided by the sum of the years and then multiplied by the depreciating base to determine the depreciation expense. And then we move to characteristics of depreciation. The first, depreciation only applies to fixed assets that have a useful life of more than 1 year. Second, depreciation is not related to cash accumulation set aside for asset replacement. And then third, depreciation must be systematic and rational, meaning it must be based on reasonable and consistent methods and assumptions. Fourth, depreciation is not affected by fluctuations in asset market. And fifth, depreciation must reflect the pattern of consumption of the benefits of the asset over its useful life. I think it is enough. Thanks for watching.